April 6th, 2026. The markets are locked. Good Friday shut everything down Thursday afternoon, and every financial terminal on Earth is frozen on the same number. Silver, $72.90 per ounce. That was Thursday's closing bid. That number has been sitting on every screen, every brokerage dashboard, every chart platform, every app on every phone for the past 48 hours without moving a single cent. And here's the problem. That number was printed before three separate events collided. Three forces that arrived between Thursday afternoon and Saturday morning while the markets were dark and no one could respond. Three forces that have not been priced into silver, into oil, into stocks, or into bond yields because the market has been physically incapable of reacting to them. On Monday morning, that reaction happens all at once. I have tracked this market every single day for years. I have watched dozens of macro shocks hit silver from different angles. And I am telling you on this Saturday morning, clearly, directly, with no hedging, that Monday morning has the specific architecture of a Black Monday liquidation event. Not a correction, not a pullback, a cascade. And the difference between understanding that ahead of time versus discovering it when you are watching a chart fall off a cliff is the difference between being positioned correctly and being carried out. So, stay with me because what I am about to walk you through is not a single news story. It is three converging forces that are going to hit the technically fragile silver market simultaneously at the 9:30 bell on Monday. And by the time I finish, you will understand not just what is coming, but why it is coming, how it will unfold hour by hour, and most importantly, what it actually means for the physical metal you are holding in your hands. Before I get into the mechanics, I want to say something to the people watching this channel right now on a Saturday morning. You are not here by accident. You are here because you already understand that the mainstream financial media does not give you the full picture. Bloomberg is running Easter weekend coverage. CNBC is discussing a jobs number in complete isolation from the geopolitical situation that makes that jobs number dangerous. None of the major outlets are connecting the dots between a ceasefire collapse, an oil market in extreme backwardation, and a private equity fund that just told 22% of its investors they cannot have their money back. This channel connects those dots. That is the entire purpose of what we do here. And today, on a holiday weekend when most content creators are offline, I'm here with a warning, not a prediction about where silver goes in 5 years. That story has not changed, but a concrete mechanism-specific warning about what the next 72 hours looks like for the paper price of silver. Here is what I want you to hold on to as we go through this. If you are a net buyer of physical silver, if you are a stacker who measures success in ounces, not paper dollars, then what I'm about to describe may not be bad news at all. It may be the best news you have heard in months. But first, you have to understand exactly what is hitting the market on Monday. And to understand that, you need to know about the three forces. There are three independent forces converging on Monday's open. Each one is significant on its own. Together, they create a multi-directional pressure system that the paper silver market has no good way to absorb. Force 1, the jobs number that nobody saw coming on Friday morning. Good Friday, a market holiday. The U.S. government released the monthly employment report. The headline number came in at 178,000 jobs gained. That is significantly above what economists had forecast. And the unemployment rate tightened from 4.4% down to 4.3%. Now, here is why that number is dangerous for silver on Monday. The paper silver market over the last 6 months has been partially carried by one dominant narrative: rate cuts. The expectation that the Federal Reserve was going to lower interest rates created a specific tailwind for precious metals. Lower rates mean a weaker dollar. A weaker dollar means higher commodity prices denominated in that dollar. That trade was one of the structural pillars underneath silver's paper price during the entire rally phase. Friday's jobs number just kicked that pillar. When the labor market looks strong, when unemployment is falling and job creation is beating estimates, the Federal Reserve has no mandate to cut. Its dual mandate is price stability and maximum employment. If employment looks fine, the Fed can focus entirely on fighting inflation. And fighting inflation means keeping rates high or potentially raising them further. Look at what happened to real money bets on the FedWatch tool after that number hit Friday morning. The day before the jobs report, the probability of an actual rate hike, not a cut, a hike, by December 2026 was sitting at 2%. Essentially, No one thought the Fed was going to raise rates. That was the market consensus. Rate hike probability, 2%, 10.5% in one morning rate cut probability, fell from 76.3%, 69.5%. That shift has not been priced into anything yet. The market was closed when it happened. Every algorithm on every trading desk is going to read that FedWatch data at Sunday night's Globex open and start adjusting positions accordingly. And silver, which has been trading with a rate cut tailwind, is going to feel that adjustment immediately. But that is the smallest of the three forces. The Strait of Hormuz has been operating at severely restricted capacity for over a month now. Approximately 20% of global oil and natural gas flows through that 33-mile choke point every single day. When that flow is constrained, the global commodity complex goes into a stress state that has cascading effects on everything priced in dollars, including silver. But this week changed the nature of that stress in a fundamental way. U.S.-Iran ceasefire negotiations, which had been driving periodic market relief rallies when peace rumors circulated, officially reached a complete standstill. Iran refused to meet American officials in Islamabad. Pakistan, which was serving as the neutral mediating country, confirmed the breakdown. This was reported by the Jerusalem Post on Friday, citing Wall Street Journal sourcing. The ceasefire pathway that markets had been pricing in as an eventual resolution is now closed. Simultaneously, Kuwait had a desalination plant and an oil refinery struck by missile and drone attacks. This conflict is not staying contained. It is spreading horizontally into Gulf infrastructure. And on the same day, a U.S. F-15 was shot down. An A-10 Warthog went down during the subsequent search and rescue operation in the Persian Gulf. These are not warning shots or posturing. These are active combat losses. Now, watch how this connects to silver through oil. Dated Brent crude has already surged past $140 per barrel. Meanwhile, the Brent futures contract closed Thursday at just under $110. Physical Brent, $140 plus futures. $110 equals $30 extreme backwardation. Extreme backwardation means the market is screaming that physical supply right now is critically constrained and that traders are willing to pay a massive premium to secure the real thing over the paper promise. Now, oil moving higher does two things to silver simultaneously. Long term, it raises mining production costs and supports silver's intrinsic floor. But short term, spiking oil triggers inflation expectation shock. When inflation expectations spike, bond yields rise. When bond yields rise, the dollar strengthens. And when the dollar strengthens, every commodity priced in dollars comes under immediate algorithmic selling pressure, silver included. So, Force 1 and Force 2 are each pushing the dollar higher and silver lower through different mechanisms. Force 1 through Fed rate expectation repricing. Force 2 through inflation expectation repricing. They are pointing in the same direction, hitting at the same moment. But neither of them is the one that concerns me most, because the third force is the one the mainstream media has almost completely ignored this entire week. Blue Owl Capital. Blue Owl is one of the largest private equity credit managers in the United States. Their flagship fund, OCIC, manages approximately $36 billion in assets. This is not a small speculative vehicle. This is a serious institutional fund holding real credit assets. In the first quarter of 2026, investors submitted redemption requests representing 21.9% of shares outstanding in that fund. Nearly 22 cents out of every invested dollar tried to exit in a single quarter. Their smaller tech-focused fund received redemption requests of 40.7%. Nearly half the fund tried to leave at once. Blue Owl's response was to cap the redemptions at 5%. Let me translate that into plain language. Investors requested their money back. Blue Owl said, "You can have 5% of what you asked for, but we are keeping the rest." When large institutional funds gate redemptions, when they legally block investors from accessing their capital, it creates a liquidity shock that radiates outward through the entire financial system. Investors who cannot get their money out of a gated fund immediately start selling whatever they can sell, whatever is liquid. Publicly traded equities, commodity futures, ETF positions, everything gets put on the table to raise cash. This is the same transmission mechanism that made the Silicon Valley Bank crisis so damaging in 2023. Blue Owl alone would not be enough to crash silver. But Blue Owl's sitting on top of a jobs-driven rate hike shock and an oil-driven inflation expectations repricing with ceasefire negotiations publicly dead. That combination creates a forced liquidation environment. And in a forced liquidation environment, silver futures get sold alongside everything else, not because of silver's fundamentals, because people need cash and silver futures are liquid. Now hold that thought, because we need to look at the COMEX, because the inventory picture at the exchange is creating a structural tension underneath all of this that is going to matter enormously in the days that follow. Total COMEX inventory, 327.66 M Oz, registered plus eligible, registered silver, deliverable 76.42 M Oz open interest. 114,379 contracts x 5,000 ounces equals 571.9 M Oz implied registered leverage ratio, 7.48 to 1 inventory drawdown from 1 year high. 38%, 531.87 M to 327.66 M Oz. 30-day drawdown, 21.5 M Oz, 6.15% monthly decline. Here's what this creates. In a normal market environment, the leverage ratio is manageable because most paper contract holders never demand physical delivery. They roll contracts forward, settle in cash, keep the game going. The system functions as long as everyone agrees not to call the bluff simultaneously. But in a Black Monday type event, when margin calls force involuntary contract liquidation, the paper selling pressure that hits silver on Monday does not erase the physical supply deficit that the COMEX inventory data is showing. It coexists with it. Paper prices fall under algorithmic selling and forced liquidation. Physical premiums at dealers quietly begin to expand because the metal itself is increasingly difficult to source at scale. That divergence, paper silver falling, physical premiums rising, is the specific pattern you need to watch for this week, because that divergence does not resolve downward. It resolves upward eventually. Before I walk you through the exact timeline, I need to set one more piece of context, because the events of this Monday do not exist in isolation. They are happening inside a monetary system that is structurally committed to one outcome. And that outcome is not deflation. The United States is carrying $39 trillion in acknowledged national debt. If you account for unfunded liabilities, Social Security obligations, Medicare, Medicaid commitments, the real number sits closer to $200 trillion. That figure is not repayable with honest dollars. It is only serviceable through persistent currency devaluation and money creation. The M2 money supply in the United States is currently sitting at a record all-time high, and the slope of the M2 line is not flattening. It is steepening. The Federal Reserve has been quietly expanding its balance sheet since December of last year. That expansion is partially why silver ran from its breakout level all the way to $121 in January. And now this week, Federal Reserve Chair Jerome Powell gave a speech at Harvard University in which he suggested that Fed balance sheet expansion is not inflationary. Read that sentence carefully. The chair of the most powerful central bank on earth is publicly building the intellectual justification for the next round of money printing before that printing begins. He is not doing that because the situation is fine. He is doing it because the situation is going to require him to print, and he needs the public to accept it when it happens. This is the most important macro signal of the week, and it is being completely overshadowed by the jobs number and the geopolitical headlines, which is exactly how these things always work. The structural announcement is always made quietly while everyone is distracted by the loud news. The Fed's intention to eventually run the printing press, stated plainly by its own chairman, is the reason that the long-term silver thesis remains completely intact regardless of what happens on Monday. When that printing arrives in force, the number of paper dollars chasing a finite, declining supply of physical silver ounces is going to expand dramatically, and the price will reflect that expansion with force. But right now, on this Saturday morning, the market is reacting to the short-term signal, strong jobs, no rate cuts, possible hike. That signal is deflationary in the near term, and deflationary near-term signals are hard on the paper price of silver. Understanding both of these truths simultaneously, the near-term bearish setup and the structural long-term bullish foundation, is what separates clear thinking from emotional reaction. And clarity is what I'm trying to give you before Monday's bell rings. Let me walk you through the specific sequence of events I am watching for over the next 72 hours. Sunday 6:00 p.m. ET. CME Globex opens. This is the first moment that all three forces get simultaneously priced into a live market. Watch the opening print for the front-month silver contract relative to Thursday's close at $72.90. If silver opens down $3 to $5 in the first minutes of trading, that is not noise. That is confirmation that Monday's session is going to be significant. The algorithms are going to be reading FedWatch data, oil spot prices, and geopolitical headlines all at the same instant. The opening print will tell you exactly how they are reading the weekend. Monday 8 to 9:30 a.m. Eastern Time. Pre-market. This is the window to watch for any official counter-narrative attempt. The ceasefire collapse is not something any government wants broadcast as a confirmed failure heading into a market open. There may be a social media post, a statement, a rumor, something designed to soften the open and give markets a reason to pause the sell-off. But here is the structural problem with that playbook. The markets and the algorithms have already been burned by ceasefire rumors multiple times during this conflict cycle. Each time a rumored peace deal failed to materialize, the subsequent selling was more aggressive. The marginal effect of each new rumor is diminishing. A counter-narrative attempt on Monday morning may slow the open. It is unlikely to reverse the direction. Monday 9:30 a.m. Eastern Time. NYSE bell. The full picture lands, and the technical setup in equities is not providing any cover. The S&P 500 is already trading below its 200-day moving average, a position of technical weakness. The Shiller PE ratio sits somewhere around 34 to 35. The only period in U.S. market history when this ratio was higher was during the dot-com bubble. The equity market is not walking into this macro shock from a position of strength. The Nasdaq chart is showing what technical analysts call a rounding top, a dome formation across the highs that is a classic signal for trend reversal. If Monday's session prints a red candle that extends below the recent support level on the Nasdaq, that confirms the dome and signals the beginning of a broader tech-led equity decline. When equities fall in a liquidity event, commodity futures fall with them in the first wave. That wave catches silver. Monday through Wednesday, COMEX watch window. Watch total COMEX registered inventory relative to delivery demands. The registered leverage ratio is already sitting at 7.48 to 1. If Monday's forced liquidation events trigger a wave of contract holders moving to demand physical delivery rather than rolling their positions, the gap between paper claims and available registered silver becomes visible in a way that usually stays hidden. Watch the one-year low. Total inventory's annual floor is 327.59 million ounces. We are currently at 327.66 million, essentially at the annual minimum. If inventory breaks below that level in the next week, it will be setting a new multi-year low. That is not a signal the mainstream media will cover. And watch the physical premium spread at dealers. If paper silver is declining on Monday while dealer premiums are expanding, if the spread between the paper spot price and the real-world price to buy an actual silver bar is widening, that divergence is telling you something important. The paper market and the physical market are operating on different supply realities. Let me draw a sharp line between two different positions because they experience this event very differently. Position 1, physical silver holder. If you own coins, bars, or rounds, if you have taken physical possession of the metal, then Monday's paper price action does not reduce your ounce count by a single gram. The algorithm in New York that sells a silver futures contract at 9:31 Eastern Time does not reach into your drawer and remove a coin. You own the same amount of silver after Monday's session that you own right now. Silver topped above $121 in January. It is currently sitting at $72.90. If Monday's cascade takes it toward the 200-day moving average at approximately $58, or potentially toward the $50 cup and handle breakout retest level, that is a reversion toward a zone where the long-term entry calculus looks significantly more favorable than it did in January. If you have been holding dry powder, cash set aside specifically for a buying opportunity, this is the type of setup you have been waiting for. Position 2, leverage paper silver. Futures contracts held on margin, options, positions with specific strike prices, ETF holdings in a panic environment. These are the positions that a Black Monday cascade affects most violently. A forced move in the wrong direction at the wrong moment with margin pressure added on top is how accounts get cleared in a single session. If any part of your silver exposure is leveraged paper, Monday morning is a session where position sizing and stops matter more than usual. Here is what does not change on Monday regardless of what the paper price does. The national debt does not decrease. The M2 money supply does not contract. The COMEX registered inventory does not refill. The Strait of Hormuz does not reopen. The Fed's intention to eventually print, telegraphed by Powell at Harvard, does not disappear. The physical supply deficit that has been drawing inventory down 6% per month does not reverse. The paper price can move from $72.90 to $64 to $58, even to $50. And none of those structural supply-demand realities change. They persist and they compound. And when the Fed is eventually forced to respond to a collapsing equity market and a credit stress event with the balance sheet expansion that Powell's Harvard speech was already pre-justifying, the paper price is going to reflect those fundamentals with an intensity that makes the move from the cup and handle breakout to $121 look like a warm-up. The crash and the bull run are not contradictions. They are phases of the same cycle. Monday may be the trough that precedes the next phase. Today is Saturday, April 4th, 2026. Silver closed Thursday at $72.90. Gold closed at $4,676. Force 1. Jobs. Rate hike expectations. 2% to 10.5%. Force 2. Ceasefire collapse. Full geopolitical risk premium returns. Force 3. Blue Owl Gates 5%. Institutional stress signal. These three forces are hitting a silver market that is already technically vulnerable. A market that lost 6% at Thursday's intraday lows before recovering to close down 2.68. A market sitting above a support floor at $64 to $66 that has held throughout this entire post-peak consolidation, but has never been tested with this combination of macro pressure behind it. And underneath all of it, unchanged, undeniable, and getting incrementally worse, the COMEX registered inventory picture. 7.48 paper claims per available registered ounce. A 38% drawdown from the one-year high. A 6.15% monthly decline rate. Annual inventory floor being touched in real time. The paper price and the physical reality are not the same thing. They have been moving in the same direction for most of the past year. Monday may be one of those sessions where they begin to move in different directions. Paper down on forced liquidation. Physical premiums quietly expanding at dealers. That divergence is how the next phase begins. For those of you holding physical metal, hold. Not because Monday is going to be comfortable to watch. It may not be. But because the ounce count in your hands is not a function of a CME algorithm's Monday morning positioning. For those of you watching Monday as a potential entry, watch the specific support levels. $64 to $66. $58 at the 200-day, $50 at the structural base. If the paper price reaches those levels while physical premiums at dealers are expanding, that is the signal. That is when dry powder becomes live ammunition. I am going to be here through this entire sequence. If you are not subscribed to this channel yet, do it right now and turn on the bell notification. Because when Sunday night's Globex Open tells us whether this is as serious as the setup suggests, I will be covering it in real time. Not recapping it after Bloomberg figures out what happened before the bell.